I'll let you into a little secret. I'm one of those people who's changed his lives so he can sleep right through the night. Not have to worry about anyone who's working for them, looking after a bunch of money. Essentially, I'm a free agent, and I sort of like it that way. That's because I've worked in an industry for the last 30 or 40 years where it's been tough to make money. In fact, for a good chunk of my career, I spent a chunk of it actually sacking people for a living and then trying to find new business models to survive. I'm a news guy, and the news industry has been transformed over the last 30 years by competition from big global tech companies, the likes of Google and Apple and Amazon and Microsoft, huge companies with resources able to essentially insert themselves in the process of making advertising revenue and providing content that people like. It was a tough gig, and I admire everyone who can actually get in there and produce news, information, entertainment, who is working differently from those big global tech companies. And a big shout out here to Duncan Grieve and the team at the Spin-Off. 10 years in that business, a tough business to be in. This week on When the Facts Change, I speak to someone who probably doesn't have a right to sleep well at night. And I talk to him about it, Steve Jurkovich, the CEO of Kiwibank. It is in one of these industries which in theory is vulnerable to an attack from outside, from a global tech firm who decides, hey, I want to be a bank all of a sudden. It's also a company like other big banks that has to think about its customers because it's so important whether or not you can pay your mortgage, whether you've got enough money in your overdraft account, and also what's happening with the overall economy. Because, of course, banking is right at the heart of it. We talk with Steve about how the economy is going at the moment in the wake of this recent rate cut, how much stress is out there, particularly in retail and hospitality, and then look at the potential for Kiwibank to be the competitive spark, as the Commerce Commission suggested. What would be needed for Kiwibank to take on the big four? What would need to change first? Should it list, as Nicola Willis has suggested? We talk about all of these things on When the Facts Change with Steve Jurkovich. And then we finish off with a chat about whether he sleeps well at night. How worried is he that banks are a bit like Kodak? Everything's fine until it's not. This week on When the Facts Change. Well, kia ora, Steve. Welcome into When the Facts Change.
Kia ora, great to be here.
Lovely to have you again to find out what's happening out there in the economy, because bank CEOs are in an unusual position. They're right at the crunch point where people are spending, people are borrowing, people are investing. What are you seeing right now?
Yeah, I mean, times are tougher. You got to kind of put it in context in a sense, because I think, everyone's going to have their view of the world and their stories. And I'll touch on two things. One is, if I think about the actual dollars and the amount of people we're assisting, we have made about 10,000 calls in the last quarter. So we've spoken to a lot of customers where they're showing potential for hardship. And of those, about 900 or so have taken up the opportunity to make some changes. 500 of those went to interest only, and about 120 customers are on the minimum. To put that in context, we have got about 400,000 retail customers that are borrowing in some way. So in the sense, it's a small number, but it's hugely impactful for the people that are making the call and creates a lot of anxiety. And the rate cut in recent times definitely gave a sense of confidence around we're moving in the right direction. I'm sure we'll talk about that a bit more, but I just had a really sobering moment last night. I was going to the New Zealand Business Hall of Fame induction thing last night, which is at the Quarters Hotel, and for listeners outside of Auckland, that's up by K Road on Simon Street. And I was coming from my home, and as I went along K Road, I was struck by, I normally walk in the mornings around my home neighbourhood, and there's quite a few empty shops, but I was really struck on K Road. There was there might have been 25 empty stores, and these are smaller stores, people that have created a small business, and, maybe it was hospitality, maybe it was retail along that K Road strip. And, it really takes the life out of places. And so in the business banking, we're certainly seeing some stress in that things are hard, but it really struck me that the knock-on effect is, there's a landlord for each of those empty shops. And, perhaps they've been the owner of that property on K Road for a long time, and so they may or may not have gearing on it. But ultimately, they're not getting any income from it. And so, if you think about that chain effect, it's, whoever was supplying that retail shop's no longer supplying it. Whoever was running that retail shop and working it is no longer doing that. The landlord's not getting any income. Those are all things that, may not immediately have an impact, but they do have an impact. So I think a lot of people are finding it stressful. I think if we asked our customers, how often do you think about, how much you're earning versus how much you're spending, I would say that a lot more people are thinking about that really carefully. On the flip side of that, I think the interest rate cuts saw people, boost themselves and think, hey, we're on the right direction. Jared and our team and The Economist believe there's going to be 300 points cut, so 12, 25 cuts maybe, or something along those lines. So, in a year and a half, we could be in a very different environment. But, it's a long answer to a good question. But, yeah.
It's tough out there. Why do you think that retail and hospitality have been hit the hardest? Because, in theory, we've had strong population growth. We've got relatively low unemployment. Anything with a 4 in front of it is quite something. I remember recessions where it was 11.
Yep.
So why is it so tough for retail and hospitality? Because some other businesses are doing okay.
Yeah, I think it's a great question. I mean, in my mind, I think what's happened is that if you think about the really critical expenditure you've got in the household. So, whether you're mortgaged or whether you're renting, the first thing you're going to pay is keep your roof over your head. And so, that's either rent or it's, your mortgage. Second thing is, and I guess you'd need to ask the insurance industry or not to see the extent to which people are cutting back on this, but is probably the insurance premium that you're paying. And then obviously you've got to pay, if you're an owner, you've got to pay rates. And those three things have all really moved in the wrong direction against you. And so that's taking, those are the things. When we ask people about financial security, every year we ask people, they always say roof over my head. And so that's where the money goes. And then you're left with what you've got. And I think hospitality and retail in particular have been pushed much more into the discretionary spend. And so I suspect that the average, and I can see from card spend, that the average spend on retail and hospitality is down a lot. And if people are entertaining, they're entertaining at home a lot more. And so I think that's what you're seeing, is that people are just cutting their cloth and saying, no, we're going to stick to the basics. And I guess in previous roles where I've been looking after rural customers, you see the same when the milk price is down. You see, people cut fertiliser, they cut a whole lot of things, and they just, grind it out. And that's what I think people are doing.
So we had that rate cut, which seemed to take longer than expected until it came, when it sort of came in a bit of a rush.
Yeah.
And as Jared has said, this begins a cycle of cuts. Now the question is how much and how fast. Do you think that the likely cuts as they come are going to be fast enough to turn things around, to get people feeling better and spending more and maybe get some more activity in the housing market?
Yeah, I mean, there's quite a bit in there, isn't there? Like, if I think about I noticed I had a review of the video that Christian Hawkesby did at the Financial Services Council. And, the point he made, I think, was, from the Reserve Bank's perspective, the data started to flow pretty fast and they became more convinced that it was time to cut. I think most people would argue, no, that was pretty evident. And so I think they were slow to cut. I think they can see now that they perhaps were a bit slow to cut, so I think they are going to cut quicker, and I think they need to. So that would be my perspective, and it's very easy in hindsight to see these things, but I do think, perhaps it's because we are a bank, we do see the flow of data a bit sooner. We can make a more instinctual judgment, I guess, than the Reserve Bank, which probably needs, to be able to rely on harder data than that. But it also suggests to me that they need more real-time data. So they're going to have to improve their capability to be able to see what's going on. And we all live in a world where we're getting streamed with lots more information than we did. So I guess the question mark for me as the Reserve Bank is, how fast are they moving forward to be more real-time in that? I think that the cuts will come. I think they do create confidence. I think what's also different this time around is because people have fixed their mortgages on much shorter terms, the impact of the cuts is going to come faster. So average time you used to fix for 2 years, a lot more people fix for 6 months and 12 months. That means that obviously, hopefully we'll get a couple of cuts in 6 months' time. You're coming onto an interest rate that might be 50 or 60 basis points lower. So that should help things. And all of those things are about momentum and confidence, because I think once that comes back in, people think, you know what, maybe we should go and treat ourselves and do a bit of this or spend a bit of that or have a night out and do those things. And, those are the differences that make a business actually turn a profit or not, because it's that discretionary spend and there's extra customer that comes in that makes the difference between, just getting by and making a living.
The other thing that's changed in the last couple of months, apart from the actual official cash rate, and of course those lower fixed mortgage rates, because international interest rates have dropped, is the Reserve Bank has changed the rules on loan-to-value ratio restrictions to make it slightly easier, particularly for first home buyers, and also introduced the debt-to-income multiple controls, which have had more of an impact on rental property investors. And then we've got the changes to the triple CFA, which the new government have brought in. Combining those together, what's that doing out there in the market for mortgages and other types of lending?
Look, I think it's making it easier practically and pragmatically. It's also convincing people about their perception that it might be a bit easier. And both those things, when they play together, work well. What's quite hard in some ways is we're noticing in our own team is that there has just been a washing machine of changes for the last couple of 3 years. And actually our executive committee was talking about it yesterday, like how hard it's been on the frontline lenders. Like the rules are changing all the time. We had to bake in a whole lot of changes, then we've had to take them out. They're talking to customers about a whole lot of acronyms that seem confusing, and they are confusing and complex. So I think it's very positive, the direction we're moving in. I think also the thing you didn't mention there is the potential for deductibility on interest as well. So that's that impending change. So all those things help and create confidence. And also I think people might be starting to sense, and I guess if you follow it, that properties might be close to the low and they're about to take off again. So I think people coming into summer and spring, people are a bit more encouraged. Property market's always a bit better during those times. So hopefully people might start to think, actually, maybe it's the time to either bring it back to market or go and find something.
Summer is coming. Also, since we last spoke, we had the Commerce Commission come out with its banking study, which said that there wasn't as much competition as they'd like to see, particularly between the big four banks. But they called on Kiwibank as an opportunity to be the David against the four Goliaths, and suggested that Kiwibank have its capital increased, its ammo, if you like, to have a go out there. What did you think of the Commerce Commission's report?
Well, I think the final report was very much what we thought we were going to get based on the draft. There was always a chance that there'd be major changes, and there wasn't really. I think it reflects the reality, which is, outside of the big four, the organisation that's got the best chance to try and shake things up is Kiwibank. If you think about our asset base at sort of circa 30 billion versus 120, they are David and Goliath sort of situations. But if you look at how fast we've grown over the last 4 or 5 years, it does show that, with the right approach and the right investment, we can make a difference. I honestly feel like we're only really scratching the surface of how impactful we can be. So, consistency of capital was the key. So we have enough capital, to keep growing. We've got a plan that's self-sustaining for the next 5 years. But if you really wanted to ramp that up and really make a difference, then obviously consistent flow of capital would be great. So I'm really encouraged by that. I also think that we're in this really unique situation where, the arbitrage between the returns in Australia and New Zealand are coming much more in sync. And so if you're sitting in Australia and you're deciding where you want to allocate your capital, you're looking at an Australian business banking market, for instance, that is growing at 7% and New Zealand shrinking at 1%. If you look at the relative economies, you'd probably argue Australia's in a better position. The Australian banks are absolutely flush with capital, and there's been huge attraction to do, the special dividends, share buybacks, which is driving up the share price. So if you're thinking about where you want to allocate your capital, once upon a time you used to look at New Zealand and say return on equity, which most people argue is globally way higher than anywhere else, is sort of 16%, versus Australia, which was 13 or 14. A logical owner goes, I'll put my money in New Zealand. When those returns are back at 12 in Australia and they're 13 and 14, you start to say, maybe I'll stick to Australia. So I think that is what's happening. And so you're seeing, realistic, pragmatic capital allocation to Australia, and that's why I don't think the big four banks are growing like they used to. And that gives us an opportunity. And I think, also if you take a view that the owner of Kiwibank sees the best medium-term value to be growing the business and not trying to take every dollar off the table in the short term, if you take that consistent approach, I believe that Kiwibank can get, really a lot bigger than it is now, still with really good returns, but not market-leading returns. So that drives competition. And then once you're big enough, the real chance is that you're big enough that people respond to you. And that's what will drive the price, not a regulatory setting or those sorts of things. Ultimately, customers have got to believe you're the right choice for them at the right price. They shift and then the others respond. And, I think that's what we've got to stay focused on, which is, we want to be the customer's first choice. We want to make them better off. And by the way, when we do that, our organisational value goes up and New Zealanders have a bigger asset.
So that consistent flow of capital, for the last few years, that's been mostly about not paying dividends to the government.
Yep.
Do you expect that situation to continue?
Yeah, I do, because, firstly, there's an ongoing capital requirement required by the Reserve Bank rules. So paying away dividend when you need more capital just doesn't make any sense, logically. But also I think a logical owner would go, I always think of about a company which is, in a way, a dividend sort of suggests there's not a better option to put that money to work. I think if you look at a bank and the way that a bank shapes up, then it's obvious that the bigger you are, the better you go. So you would keep reinvesting your retained earnings. So a logical owner for me wouldn't ask for a dividend. But I appreciate that's the owner's, discretion.
So the response from the finance minister, the owner, if you like, has been, well, yes, there's an opportunity for Kiwibank. One way to ensure there's more capital going into Kiwibank would be to have a public listing, which some companies like as a way to, raise their profile with their customers, to have more connection with investors, and to get other potential sources of capital in there. What's your view on a potential listing?
Yeah, I think I absolutely agree with the point that you're making. I think the nearer term probably doesn't make the most amount of sense for us because we've still got a couple more years of heavy transformation spend. So I think that would be impactful in terms of would you be distracted by the public listing to an extent? I think that's probably true. So I think a listing's way more likely and logical next election cycle. We don't need the extra capital at the moment. And so again, I think it sort of makes sense. Why would you list right now? I think, the really encouraging thing from the Minister of Finance in her public commentary has been she wants all options on the table. And I think that's the best way to go forward because that creates the most, tension, if you like, about who might be interested, what sort of capital flows in. There's obviously some emotive elements to people feel like it should always be 100% owned by the government. There shouldn't be anyone else involved. But I've operated in sort of 3 or 2 situations. One when we had New Zealand Super, ACC and New Zealand Post as owners, and I've operated when we've had 100% Crown ownership. Has it made a difference for customers in the way we approach things? Absolutely not. So that doesn't distract you. We have publicly listed securities in our debt, so we already do some of the things that a listed company would do. But the point you make around direct ownership by customers and by New Zealanders, I think that would be invigorating, and I think that would give us a chance to really prove that we're worth it, and it might bring some different disciplines. So, all those things would be interesting, but, not my choice. But from my perspective, it doesn't spook me to think that we might have to do that.
You mentioned transformation and that, you're pretty busy doing that. What sort of things are you doing there?
So we are heavily investing more than we ever have every year in trying to get to the future as fast as we can. And that future looks like, a cloud native core banking. It looks like, globally leading platform to do our lending off. It looks like data capabilities that allow us to do much better at knowing and understanding the customer, offering them things that are timely, that are relevant and make a difference for them, but keeping things simple and easy. Every bank is in this journey, and we have seen publicly, that a couple of the bigger banks in New Zealand have signalled that they're about to spend, material amounts of money, a couple of $1 billion about getting to the future. What it really allows you to do is be way more adaptable and a lower cost of change to be able to do things for customers, but also respond to regulatory situations that change and things like that. When you're dealing with a heritage stack, making changes is really complex and very expensive and actually quite risky. And people see an organisation, say one of the big banks that's making $1 billion, or us making, more than 200 in a record year, feel like, oh, you've got so much money, you should be able to do it. Well, actually, the risk and change is really high. And that has been one of the challenges of all of the changes we saw in the triple CFA and all those things, is every time you make one of those changes, it's connected to so many things that there's a risk that, something goes wrong that you don't know about. So it makes you very cautious. Throw in the fact under triple CFA that there was, personal responsibility for directors and senior officers, that always amps up the attention as well. And, I think that's why we've felt like we're slow. We haven't been able to get onto some of the things that customers would want us to do, is because we've had to do the legislative things that are required, and they're quite hard.
So part of that competitive landscape is the idea of open banking, which the Commerce Commission has got involved in, and there seems to be some momentum finally developing, and some of the fintechs seem more active. There is an opportunity, though, here for someone to come flying out of left field or right field or wherever to, because they don't have a legacy of all of those stacks that have to be carefully Jenga-fied around, that they can just go for it. What do you think about the potential for open banking to be the competitive spark that changes the landscape? And, is this something that you're interested in taking advantage of?
Yeah, we are. I mean, I think if you stand back a little bit and you think about what open banking is about, it is about allowing people to bring new offerings to market in a faster way at a lower cost. Also allows you to hopefully do things where you can be a lot more niche. Like, for instance, a different language version of what you're doing. Like for us, there might be a niche out there where someone wants to offer something for, say, like Islamic banking or things like that, which wouldn't be, it wouldn't be useful for us in the sense of there wouldn't be enough customers. It would distract us from a whole lot of things to do. But for the people that are really interested in that might be really useful. So there's those sorts of ideas. The evidence set for open banking really changing things is really low. And so that, in the one sense, kind of makes me feel like, is there going to be a really big impact in the short term? Look, I don't think so, and I can't find a country where that has been the case. But, people said the same thing about Kodak, right? Which is, no one's ever going to want to take photos with their phones, and all of a sudden the whole world's changed. So I don't want to sound like I'm from the flat earth, because it can change things, but probably much more interesting for me is a combination of open banking, consumer data rights, and some form of digital identity. So if you could marry digital identity and all of the complexity that comes with consumer data rights and open banking, then you're starting to get a real mix of things that allow people to move faster, to be able to adopt new services in a much more seamless way. And I know digital identity is a hot topic for many people. They feel like, Big Brother's watching them and things like that. But the hundreds of millions of dollars that are spent in real estate and lawyers and, accountants and everyone else that has to do know your customer, all of that money could be redeployed into either, more useful investment or just being spent in the economy. And if you can get that going and give people way more control about their data, then I think, you're off to the races. What you also have to understand, I think, is, Steve's startup, you may or may not want to trust Steve with your data, because I don't really know what sort of cybersecurity Steve has. I don't know how Steve's going to use the data. I don't know where it's going. So there's a lot of fishhooks in it, but that to me feels like a really big enabler. And, part of me thinks, man, we've only got 5 million people, like in a sense. We are not America with 360 odd million or whatever they've got. Like, we could do this if we decided to do it. And I just think we need a national posture that says to ourselves, if we can do the right thing with the right rules, we can really shift things around, taking a lot of friction out of the system, and that would enhance competition.
Because we've been here before. FPOS was the great New Zealand innovation, but there seems to have been a fading of that innovative, let's do it on our own and do it different and better in recent years. Why do you think that is?
Yeah, it's fascinating, isn't it? Because I was trying to think in recent times about when I was thinking about open banking, just to try and test myself whether I'm being pessimistic or I'm being an incumbent and I'm not thinking about it in the right way. And I was sort of thinking, in New Zealand history in like recent times, there's only, can think of really only 2 companies in Xero and Trade Me that have really scaled. And it's been a while, why is that? Is it about, is the attractiveness around taxes or what's going on? Is it the access to capital? Is it regulation? Maybe it's all of those things. But yeah, there feels like a gap. I'm sure there's some great businesses out there that are thinking as they hear that, well, just give me a chance and I could really do it. But yeah, I think we could, we're always clearly better off when companies like that really go for it.
Just finally, as a banker, I always wonder how they manage to sleep at night when they're thinking about the likes of an Apple or an Amazon or a Facebook or an Alipay or someone like that, finding New Zealand on the map. Maybe they get a new map that's got New Zealand on it.
Yeah.
And they go, hey, you know what? They all trust us. Let's say it's Apple.
Yep.
Let's say it's maybe not Facebook, but Google. And this, there's a lot of huge names that we all connect to, that we've invested our time in getting identity. We trust our money with them to spend. Why hasn't that really happened in banking yet? Because if I was Apple, if they've got $200 billion of cash at least sitting there, they've got connections to everyone. We trust them all, in theory. I can't work out why they haven't, scared everyone witless by jumping in there.
Oh, look, I agree. All your Android customers will be arcing up, but the point that you make is a really good one. And when you look in some markets, like particularly, I've just recently travelled for work to America. That sort of security and ecosystem that Apple has created, where they're prepared to take on federal government about not releasing information. They've really driven this proposition that they're the safest and most secure. Now, 2 ways to think about that. Yep, that may be true, but they've also created this massively walled garden with a big moat around them. And so I think it's actually, business genius the way that they've done that, to be fair. But I do think, they've got some firepower, and you only need to look at the media industry and go, if they turn their sights on you, it's really hard. And sort of a funny anecdote, what someone told me once was, they were in the media industry and they sort of said it's like Game of Thrones. If the invaders are coming from the north, it doesn't help when they turn up, knowing that they were coming. It's like when they arrive, it's super nasty. So, yeah, I think the Wise card is the classic example of what you're talking about. So the Wise card has attacked a part of the financial services system that was high friction, high margin, and really inconvenient. Those things are, always where disruption hits. And if you're a Wise card user, and I'm not being paid to say this, it's way easier. Now, something could happen to Wise, as we're speaking, but what I think, has happened is that people complain about banks in the sense that, it is complex to do. I don't know what the spread is or the margin is. It's high fee and my money disappears for days on end. Like, what's that about? And then Wise have turned up and you switch the money in real time. The app is easy to use. It's easy to join, maybe a little bit too easy, some people would argue. But that is a classic example of where our lunch is being cut by a disruptor who doesn't have to do everything else we do. All they care about is international payments and currency swap. They don't have to do all the capital and regulatory requirements. And so I think if an Apple turned up or a Google decided, hey, there's a lot of money being made in financial services, we'll go after it. Someone once argued to me is actually they are doing so well elsewhere. Why do they want to distract themselves with it? That's a pretty good argument as well.
Steve Jurkovich, the CEO of Kiwibank. I hope you can sleep at night. I'm sure you do.
No, mostly.
Thank you for coming on to When the Facts Change.